Hello, friends. Let us continue our discussion on the concept of cost of capital. Uh, some basic aspects of cost of capital we had discussed in your previous session. Let me share my screen with you now. We have already understood that when you are talking about the cost of capital, and we are also aware of that capital consists of two things broadly. One is equity, other one is the debt. There might be other elements also, like reserves and surpluses, or maybe preference capital. But if you talk about cost of debt and cost of equity, they are the two major components. First, we'll be learning how to compute cost of debt. Then we'll become computing cost of equity. Then we'll see how to compute the cost of other elements of capital. Previous class, we had discussed that when you're talking about cost of debt, the two types of, or you can say there are two ways to compute this thing. One is called as pre-tax cost of debts. Other one is called as the post-tax cost of debt. Or you can call it as before tax cost of debt and after tax cost of debt. And if you know the before tax cost of debt, you can easily compute after tax cost of debt or post-tax cost of debt very easily if you know the tax rate. Because post-tax cost rate, post-tax cost of debt is equal to pre-tax cost of debt into 1 minus tax rate. So if you look at the formula here towards the last part of this slide, you see before tax rate into 1 minus marginal tax rate. This is how we can compute. Suppose before tax cost of debt is 3.5%. And our after tax cost of debt will be, before tax cost of debt, let us say 5%. The after tax cost of debt will be 3.5%. How it will be calculated? 5% into 1 minus 30%. 30% is the tax rate. This is the concept we had discussed in our previous class. With the help of this table, I had explained you that because someone is taking debt in his capital structure, there will be tax saving. Here we had shown it. Let us say someone is going for equity finance, another person is going for debt finance. Right. Equity finance, in that case, he has to pay a tax of 3 rupees. And in case of debt finance, he has to pay a tax of 0.6 rupees. Therefore, there is saving of 2.4. That will be reduced from the cost of debt. Cost of debt means interest is, you see, 8%, 8 rupees is paid, but there is saving of 2.4. So effectively, 5.6 is the cost of debt. So if you look at the formula here, you see KD, small d. K small d refers to post-tax cost of debt, which is equal to pre-tax cost of debt, that is K capital D, into 1 minus T. T is the tax rate. In this example, it is assumed that tax rate is 30%. Hope you have understood this. Okay. Pre-tax cost of debt calculation is very simple. Look at here in this slide, talking about interest by PG. That means interest divided by value of the debt at current time. Okay, P0 means at time period 0, at time point 0. And post-tax cost of debt, again, you look at here, it is saying K capital D into 1 minus T. So these are the formula which will be relevant for you. Right. So you can look at the slides again. And on that basis, we had computed an example. Let us say perpetual bond is sold at par, coupon rate is 7%, compute cost of debt. So 7% interest is paid, that is the cost of debt. Another example we had seen, let us say is 7-year 15% bond, face value of 100 is sold at 90. Face value 100 sold at 94. That means discount is given 6 rupees. The discount should be distributed across the life of the asset. Life of the asset, you see, 7 years. So if you look at here, the cash flow structure will be here. At 0 year, at time point now, the company will be getting 94 rupees because he has issued a bond. A discount, he's be receiving 94 rupees. From year 1 to 7, every year he has to pay, there will be outflow of 15 rupees. And on year 7, company has to redeem, he has to pay 100 rupees. So this is the cash flow structure. Okay, inflow 94, outflow 15, 15, 15, like this 7 years, and then 7th year again 100. If you can compute the internal rate of return of this cash flow, that will be the cost of debt. But there is a shortcut formula to compute cost of debt. Here the shortcut formula is like this: interest per annum plus average other cost per annum divided by average fund deployed. Interest per annum, 15 rupees is paid per annum. And what is the average cost per annum? Redemption price minus issue price. The bond will be redeemed at 100 rupees, issued at 94 rupees. So there is a discount of, there is a loss of 6 rupees. That has to be divided across the life of the asset. So 100 minus 94 divided by 7. Whole divided by average fund deployed. You are getting 94, redeeming at 100. So average fund deployed is 100 plus 94 divided by 2, 16.3%. Okay, so that is, you can say, kind of a rough cost of debt. Okay, but real cost of debt, if you want to come to an accuracy level, then you have to compute IRR. You need to know how to compute IRR. In IRR, what happened? This we can take it as our case rate. Let's say 16.3 is coming. We'll assume that 16. We'll guess that 16% is the cost of debt. At this rate, we'll be discounting the cash flow. We'll be finding out what is the net present value of that cash flow. Let me show you here. So we have assumed now that cost of debt is, let us say, 16%, or discount rate is 16%. Okay. If you now discount this cash flow, 94, then year 1 to 7, 15 rupees, this is an annuity, then year 700. Okay, discount factor for time period 0 is always 1. So 94, here I am taking year cash flow, discount factor, discounted cash. Here you see 94, discount factor, year 0 is always 1. So 94 multiplied by 1 is equal to 94. Second is an annuity. It is not one cash flow. For 7 years, every year 50 rupees will be paid. Right? So what is the discount factor for that at 16%? We have to calculate that thing. How to calculate? We have to refer to a table. These tables are readily available in the financial management books. So we'll see that at 16% for 7 years, what is the factor we'll be computing here. Then after that, finally, 100 rupees will be paid at year 7. It's a single cash flow. For this single cash flow at 7 years at 16%, what is the rate? We'll find it out. So we need to refer to now the tables at 16%. Okay. So many of you may not be knowing how to refer to the table. So I'll do one thing. I am sharing my screen. Let us see how table look like. If you watch any financial management book, towards the towards the end of the book, you'll be able to find certain tables. One of the tables will be present value factor table. You see, table looks like this. I think you are able to see. Right. So we want to calculate present value table. Okay. Present value of a, first of all, annuity. Annuity means that we are talking about that 15 rupees is paid for 7 years at 16%. So first you see, let me increase the font. We are looking for factor for 7 years. You see, this is the E period, 1, 2, 3, 4, 5, 6, 7. So this is the period we have selected this one. At what percent? At 16%. At 16%, this is the 16%. Okay, this is the future value factor I'm referring. Let me take you to the present value factor. Yeah, this is the right table, in fact, present value factor. So there will be many tables towards the back side of your book. Some of them are present value table, some of them are future value table. If periodically you are receiving some money, same amount, let us say over a particular period, you are receiving, you have to refer to the present value annuity factor table. First see that you are referring to the correct table. Here you see present value of an annuity. So we are referring, this is the table. For 7 years, this is the row. Okay. And at 16%, this is the column. You can find out this is the factor. 4.039 is the factor. If you multiply this, multiply our cash flows with 4.039, you'll be getting the present value of that amount. What is that amount? That whatever money is there for 7 years, 15 rupees is paid. That amount has to be multiplied with this factor to get the present value. And the last, okay, so if you look at the slide, you can see it is multiplied with 4.039. Please note down this factor. We also need to know the present value factor of a single sum at the last of the period, the end of the period. What happens? 100 rupees is returned. Okay, we need to compute what is the present value of that 100 rupees. But the 100 rupees is a single sum, not paid periodically. For that thing, we have to find out, so we have to refer to the present value factor of a single sum. Present value factor table, it's a different table. So let me take you to that table also. Present value of a lump sum. Yeah, this is the present value factor table. We also need the factor for 7 years at 16%. Look at here for 7 years at 16%. If you see, what is the factor? Point. Just have a look. You see, it is for 7 years, the period, 16%, 0.354. These two factors are important for us. Now, let me show you the PPT you see. And that is why we are multiplying this 15 rupees with 4.039 and 0.35. When you multiply this cash flow with discounted factor, you are getting minus 60.58. And if you're multiplying 100 with 0.354, you are getting 35.4. So net present value coming to, if you add all these numbers, it is coming 1.98 negative. Okay, this is how we have computed NPV. But NPV is coming negative here. To compute IRR, we have to compute one more NPV. Since NPV is coming negative here, what we are going to do? We are going to go for a higher rate. Let us go for another discount rate, little higher. Let us say we are discounting at 17%. 16%, you know, it is coming negative. If you discount at 17%, similarly, you have to refer to the table. 17% factors will be different. Okay, once again, let me show you what is the factor at 7%. Okay, just 1 second. Let me share my screen with you. Now you see. So this is the single sum. 17%, you see, this is the table. At 7 years, 0.333 is the factor. And if you refer to a present value factor for annuity, again, I'm showing you the table. These tables will be available. Otherwise, you will be able to download it from the net. 17% at 7 years. 3.92. Okay, sorry. I think screen is not shared. Just give me 1 second. Just give me 1 second. Yeah, I was telling you that you have to refer to the table, present value factor table. You see, this is the present value table of an annuity. If you take it 17% at 7 years, the factor is 3.922. So this is one factor. If you take the single sum factor, single sum, I have to refer to a different table. Present value factor of a single sum, if you see, now you see, just a minute. Yeah. Now you see single sum at 17% for 7 years, 0.333. These are the two factors which are important to us. Let me stop sharing this screen now. I'll go back to my PPT. Okay. Now these numbers, these factors are taken from those tables. You might be thinking, where from I'm getting this number? These numbers I've taken from these tables. Okay, this type of tables should be shared with. So 3.922, this is the discounting factor. Then 0.333 is the discount factor. If you multiply this thing, these figures, cash flow figures with discounting factor figures, you'll be getting discounted cash flow. And if you totally aggregate all these discounted cash flow, it is coming 1.87%. That means what we have seen, if you're discounting at 16% in the previous slide, you see discount, the NPV or net present value is negative 1.98. When I'm discounting at 17%, it is 1.87%. So one NPV is available negative number, another NPV is available at positive number. So how to calculate IRR? To calculate IRR, we have to use this formula. Watch this formula carefully. It is IRR is equal to L1 plus NPV at L1 divided by NPV at L2 divided by NPV at L1 minus NPV at L2 multiplied with, or you can say whole multiplied with L2 and minus L1. Right? L1 is the lower rate. L2 is the higher rate. So you have taken two rates. One is 16%, another 17%. Lower one is 17% is the higher. NPV at L1, you know, we have computed two NPVs. One is at 16%, another is 17%. If you put that in this formula, you'll be getting this figure. 16%, which is L1, plus NPV at L1, which is minus 1.98, divided by NPV at L1, that is minus 1.98, minus 1.87, which is a positive number, whole multiplied with L2 minus L1, that is 17% minus 16%. If you solve it, it is coming 16.51%. That is, you can say, exactly, that is the cost of debt. Okay, now you have understood the cost of debt computation. Little, it may appear to be little complex. Okay, so this is the right approach of computing cost of debt. If you want to adopt a shortcut method for that, the shortcut method is what I had told you in a previous class. You simply calculate like this. It is coming 16.3%. But this is not the accurate number. 16.3% we have calculated by using this formula. Interest per annum plus average other cost per annum, whole divided by average fund deployed. By using this formula, we have already computed 16.3%. Okay, so you can compute like this in your examination also. At your level, this computation will be sufficient. But actually, if you want to bring accuracy to your answer, then it is not 16.3, it should be 16.51. That is the right answer. Okay, so with this, friends, we have concluded our concept of cost of debt. Okay, right. So we'll stop here. We'll catch up maybe in a gap of 5 minutes. Again, we are going to catch up with a new concept. Thank you. We'll catch up. Please join in 5 minutes.